If you panicked this morning, you lost. Oil spiked 25% overnight to a 4-year high of $119, and the markets gapped down. But then the White House stepped in, oil crashed 15% intraday, and the Nasdaq just closed green. Welcome to the wildest Monday reversal of the year.
I mean, the sheer velocity of that institutional counterforce it's something we rarely see outside of historical black swan events. To see a geopolitical premium of that magnitude just get systematically dismantled in, what, a matter of hours? That requires a very specific convergence of market mechanics and absolute political desperation.
Welcome to today's deep dive here on Theta Fuse. It is Monday afternoon, March 9, 2026. The closing bell has just rung, and you are staring at your screens right now. You are looking at a tape that tells a completely different story than the absolute bloodbath we woke up to at 8:30 a.m.
Yeah, a completely different reality.
Today, we're viewing this chaos exclusively through our lens: options trading, implied volatility, and LPS. Our goal today is to give you the mechanical breakdown of how this whipsaw actually materialized. Because days like today, these are where generational premiums are either captured or they're lost forever.
Right, and our mission for this deep dive really covers three distinct structural shifts that happened today. First, we need to deconstruct that historic overnight oil volatility. We have to look at the physical bottleneck that caused it, and then unpack the subsequent White House scramble that triggered the violent intraday reversal.
The intraday reversal that saved the indices.
Exactly. And second, we have to look at the casualties. The broader market may have recovered by the afternoon, but the airline sector absorbed massive structural collateral damage that is not going away tomorrow.
Well, it's definitely not.
And finally, we're going to uncover a hidden multi-billion-dollar trade in the pharmaceutical sector. There is a massive capital reallocation happening right now, and I mean, the broader market is completely blind to it because everyone is fixated on the crude charts.
The price action today bordered on the absurd. I mean, going from absolute terror to a tech rally in the span of a single trading session, that's the kind of volatility that breaks retail accounts. But it feeds option sellers. So let's start with the terror. Let's talk about the overnight futures market, because waking up to see oil at a 4-year high, that changes the entire macroeconomic calculus for you.
It forces a complete repricing. The data rolling in from Sunday night into Monday morning, it presented a literal worst-case scenario for energy markets. Both West Texas Intermediate, WTI, and the global benchmark, Brent crude, violently surged past $119 per barrel.
Which is just a staggering number to see on a screen.
It is. That represents a 25% spike practically overnight. To put the sheer momentum of this move into perspective, WTI is now up 50% for the month of March alone. We have to look back to the historic, that negative price phenomenon of April 2020 to find a monthly move of that magnitude.
Right, when the contracts literally went below zero.
Exactly. And Brent crude followed suit today, up more than 40% on the month, which marks its biggest monthly gain going all the way back to 2007.
Whenever we see a spike like that, the immediate question for you as an options trader is this a speculative bubble driven by paper trading, or is there a physical catalyst? And in this case, the catalyst is entirely physical. The Iran war escalation has effectively brought traffic in the critical Strait of Hormuz to a complete grinding halt. We are watching a physical supply bottleneck happen in real time.
And that distinction between paper speculation and physical supply destruction is everything when you're pricing options. The Strait of Hormuz is the world's most important oil choke point, period. Roughly 20% of the world's daily oil consumption passes through that specific waterway, connecting the Persian Gulf to the international market.
It's the jugular vein of the global economy.
It really is. And the latest tracking data from Vortexa paints a grim picture. 16 million barrels per day of oil are currently stranded behind the strait. You cannot paper over a 16 million barrel daily deficit. Furthermore, Kuwait has confirmed unspecified production cuts, and we are seeing reports that Iraqi output is plunging by about 70%.
So the supply crunch isn't a forecast. It is physical, and it is immediate. If I'm sitting on an institutional trading desk looking at those Vortexa numbers, my models are absolutely screaming. But how high can the algos realistically push this? What was the worst-case scenario that had the futures dumping so hard before the open?
Well, the panic was heavily fueled by a strategy note released by Macquarie, specifically from their energy strategist Vikas Stovedi. The note warned that the market isn't just dealing with a temporary delay. Just a few weeks of a sustained Hormuz closure would trigger a massive domino effect across global supply chains.
They were just modeling $119, were they?
No, Macquarie was explicitly warning of a scenario where crude is pushed to $150 or higher.
Let's pause and think about what $150 oil actually means for the broader economy. If oil hits $150, every single logistical input cost skyrockets. Shipping, manufacturing, plastics, agriculture. It essentially forces the market to price in a brutal repeat of the 2022 energy price shock.
Right. A prolonged supply shock of that magnitude acts as a massive regressive tax on the global consumer. It immediately squeezes corporate profit margins and economic growth while simultaneously reigniting inflation. Central banks would be entirely cornered.
Because they can't cut rates to stimulate growth if inflation is roaring back.
Exactly. And they couldn't hike rates without pushing a fragile economy into a deep recession. That $150 phantom number is exactly what triggered the initial $6 trillion wipeout in global equities right at the opening bell.
But by 1:30 p.m. Eastern Time, we saw something incredible. Oil suffered a massive intraday slide. It fell 15%. Brent pared all the way back down to $100, and WTI actually fell to $95. That is violent rejection of the morning highs. If the strait is still physically blocked, what on earth caused a 15% crash in a matter of hours?
The threat of overwhelming government intervention. The Trump administration is staring down the barrel of the midterms, and the national average price of gasoline just hit $3.47 a gallon. That is a 16% jump in just 1 week. Political survival always trumps free market price discovery.
Always.
According to a Reuters exclusive that dropped midday, the White House is in an absolute state of panic, frantically assembling emergency proposals. White House Chief of Staff Susie Wiles and top advisor Stephen Miller are driving intense deliberations to artificially put a lid on U.S. prices, regardless of the global physical shortage.
They're essentially threatening to throw the kitchen sink at the energy markets. If you are an options trader, tracking these specific policy levers is fundamental data because it caps your upside risk on crude calls. You cannot trade the technicals if the government is about to rewrite the rules. Let's break down this arsenal of options they're reviewing. First up, we heard rumors of a joint strategic petroleum reserve release, coordinated with the G7.
Yeah, the SPR is the most immediate tool at their disposal. The G7 ministers have already signaled they would consider tapping the International Energy Agency's strategic reserves. But releasing reserves only provides a temporary buffer. The White House is looking much deeper into domestic structural levers. They are actively considering implementing export curbs, intervening directly in the oil futures markets, and even waiving federal gas taxes to artificially lower the price at the pump for the consumer.
Waiving the gas tax feels like a quick political win, but the one that really caught my attention was the discussion about lifting the Jones Act. For anyone who doesn't track arcane maritime law, the Jones Act is a century-old regulation requiring that any cargo shipped between two U.S. ports must be carried on U.S.-owned, U.S.-flagged, and U.S. crewed ships.
Which makes domestic shipping incredibly expensive.
Exactly. Because that site is so small and expensive to operate, it is historically cheaper to ship oil from Texas to Europe than from Texas to New Jersey. If they waive that act, how does that mechanically change the market?
Waiving the Jones Act would be a seismic shift for domestic logistics. It would instantly allow foreign-flagged vessels to pick up crude from the Gulf Coast and deliver it directly to the refineries on the East Coast. It immediately cheapens the logistics of moving domestic fuel, completely bypassing the international bottlenecks. When you stack the threat of an SPR release, export curbs, and a Jones Act waiver altogether, the market suddenly realizes that the White House views $100 plus crude as an existential political threat.
Which brings us to the core Theta Fuse lesson for today. If you take nothing else away from this deep dive, write this down. The government is fighting the geopolitical premium. Never bet blindly against intervention. When a commodity price threatens national security or political survival, you can take your fundamental supply and demand charts and throw them out the window. You have to trade the policy, not just the barrel.
And understanding that policy response is the key to decoding the broad market whipsaw we witnessed today. The morning session was defined by absolute carnage. Global markets were bleeding heavily across the board. That $6 trillion in global market value was temporarily erased in a matter of hours. At the open, the Dow sank 0.8%, dropping over 450 points in a straight line.
That's too free fall.
The S&P 500 dropped 0.7%, and over in Europe, the stock's Europe 600 index fell 0.6%, which capped off its worst week since April.
It felt like indiscriminate panic selling at the open. But as the midday news broke about the White House intervention and crude eased back toward that $95 to $100 range, the major indexes caught a massive bid. The tech-heavy Nasdaq composite, which had suffered brutal losses early in the day, actually fought its way back, flipped green, and closed up 0.1%.
The Dow and S&P pared their losses significantly, too. The institutional money clearly bought the dip the second they smelled price controls.
The metric that options traders needed to be watching during this entire roller coaster wasn't the price of the indices, but the volatility derivatives. Specifically, the CBOE Crude Oil Volatility Index, under the ticker symbol OVX. Today, the OVX printed a staggering high of 110.83.
Hold on, let's unpack the mechanics of the OVX for a second, because commodity volatility functions very differently than the equity volatility most retail traders are used to.
Right, because when you look at the VIX, the standard stock market fear gauge, it typically spikes when the underlying S&P 500 falls. It has an inverse correlation. People buy puts to protect their portfolios, driving up the VIX. But the OVX, which is calculated from the options on the United States Oil Fund, often climbs alongside the underlying asset price. Right?
Exactly. The OVX measures the market's expectation of 30-day volatility in crude oil prices. Unlike equities, where panic is associated with a crash, panic in commodities is often associated with a vertical supply shock. When oil surges violently upward due to a war or a blocked strait, the demand for call options to hedge against skyrocketing fuel costs explodes. This drives the implied volatility and therefore the OVX through the roof.
Let's contextualize that 110.83 print. Seeing the OVX over 110 is just mind-bending.
An OVX print of 110 is historically anomalous. For context, the OVX has not traded above 100 since the pandemic crash of April 2020, when oil futures literally went negative. Hitting 110 indicates absolute historic panic in the options chains. The premiums being paid for out-of-the-money calls and puts on oil this morning were mathematically astronomical.
The market makers were demanding massive compensation to take on the risk of writing those contracts.
Precisely, they were terrified.
When implied volatility hits a 4-year high strictly on a geopolitical headline, that spells massive mispricing. And where there is mispricing, the option sellers, the Theta gang, are the ones who step in and feast. We're going to get into the exact mechanics of how to trade that kind of volatility spike in a few minutes. But first, we have to talk about the collateral damage. Tech and blue chips may have recovered today, but there was an entire sector that was left for dead.
The airlines, they were the undeniable structural casualties of this $100-plus oil environment, and their recovery is going to be incredibly difficult to engineer.
The stock carnage across the aviation sector was just ugly to watch today. In the pre-market, we saw massive gap-down drops across the major domestic carriers. United Airlines plummeted as much as 7%, American Airlines was down 6%, and Delta fell 5%.
And the contagion wasn't isolated to the U.S. European carriers were absolutely battered. Lufthansa tumbled roughly 5%, while British Airways parent IAG and Air France KLM both slid 3%.
Evaluating this from a fundamental perspective requires looking at the raw unit economics of operating an airline. Jet fuel is not a peripheral expense. It accounts for between 20% and 25% of an airline's overall operating costs.
It is an incredibly fuel-sensitive business model operating on notoriously razor-thin margins. According to data from Patrick DeHaan, the head of petroleum analysis at GasBuddy, fuel costs have risen by as much as $1.75 per gallon in just recent weeks.
Let's do the brutal math on that, because that metric is the fundamental thesis for why institutional money was heavily shorting these names or buying puts at the open. If fuel goes up $1.75 per gallon, how did that translate to the balance sheet of a major carrier?
That $1.75 per gallon increase translates to roughly an extra $1.5 billion in quarterly costs per airline.
Per airplane. That's insane.
Yes, per airline. When you aggregate that across just the big three domestic carriers, Delta, American, and United, you are looking at a nearly $5 billion hit in unforeseen additional expenses for a single quarter. That wipes out profit guidance entirely.
So airlines are getting crushed because they have zero defense against foreign supply shocks. But what blows my mind is that they used to have a defense. They used to hedge against exactly this kind of scenario. Southwest basically looked at the most volatile commodity on Earth, shrugged, and said, we'll just wing it. I feel like I need to start hedging my own airline baggage fees at this point. Why did the entire industry abandon fuel hedging?
It really comes down to short-term Wall Street pressure. Historically, U.S. airlines heavily utilized derivatives like call options on crude or futures contracts to hedge against rising fuel costs. They would lock in prices to protect their margins from geopolitical shocks. But hedging acts like insurance. It costs money.
Right, there's a carrying cost.
Exactly. When oil prices were relatively stable or falling in recent years, those hedges expired worthless, and the airlines took paper losses on the derivatives. Wall Street aggressively punished their stock prices for those hedging losses. The pressure became so intense that even Southwest, which was famously the industry's most active and successful fuel hedger, officially threw in the towel and ended the strategy in 2025.
They capitulated to the analysts, and now they are completely naked in this market. They have zero structural defense against this Hormuz squeeze. It is the equivalent of canceling your homeowner's insurance to save a few bucks right before a Category 5 hurricane makes landfall.
The lack of hedging creates a severe double whammy for the sector. U.S. carriers were already facing brutal headwinds coming into March. The industry is down between 20% and 30% year-to-date because of the massive winter storms that previously forced the cancellation of thousands of flights, severely denting Q1 revenue.
And now you add the geopolitical layer. The Middle East conflict has already grounded more than 20,000 flights, stranding thousands of passengers and scrambling global logistics.
The downstream effect on the consumer is going to be painful and immediate. United Airlines CEO Scott Kirby didn't even try to sugarcoat it. He came out today and explicitly warned that the impact of higher fuel costs on airfares would probably start quick.
Airfares are about to skyrocket right before the spring travel season. If you hike prices 20% to cover fuel, you destroy demand elasticity. Families simply stop booking vacations. It is a nightmare scenario for their forward guidance, which is exactly why the airlines did not participate in the afternoon market recovery.
Observing the capital flight from the airline sector raises a critical question for options traders. If institutional money is fleeing unhedged, geopolitically sensitive sectors and only cautiously stepping back into tech, where is the massive structural capital actually flowing?
This is the pivot. We love finding the trades that are happening beneath the fold, buried under the radar of the mainstream financial news cycle. While everyone is staring at oil, Big Pharma is entirely reshaping the U.S. medical supply chain.
The looming catalyst driving this massive reallocation of capital is President Trump's threatened 100% tariff on imported medicines. It is a sweeping, aggressive policy threat designed explicitly to force domestic manufacturing and reshore critical medical supply chains.
Global drug makers are terrified of this 100% penalty. A 100% tariff on a high-margin pharmaceutical product completely destroys the business model. So they are rushing to secure exemptions via the administration's new TrumpRx.gov platform. And they aren't just filling out paperwork. They are deploying capital at a scale that is hard to comprehend until you look at the raw expenditure numbers.
The billions being deployed right now represent a historic reshoring rush. Global pharmaceutical giants are essentially buying their way out of the tariff threat through massive domestic infrastructure investments. Pfizer and AstraZeneca have already secured multi-year tariff exemptions through complex pricing deals and ironclad commitments to the new platform.
Let's follow the money on these specific plays because these are the companies building the moats.
Yeah.
Pfizer literally just signed a $70 billion deal. That is $70 billion allocated for research, development, and domestic manufacturing inside the United States, all engineered to buy themselves a 3-year grace period from these tariffs.
Eli Lilly is employing a similarly aggressive expansion strategy to dodge the penalties. They have formally committed at least $27 billion to build 4 new U.S. plants to expand their domestic production capacity. Furthermore, just this past January, they announced a brand new $3.5 billion pharmaceutical manufacturing facility in Pennsylvania. They are physically cementing their supply chain within U.S. borders.
And it isn't just American companies reshoring. The foreign giants are being forced to set up shop here, too. Roche, the massive Swiss drug maker, is investing $50 billion in the U.S. over the next 5 years. On top of that, they announced a $550 million expansion of their diagnostics manufacturing hub in Indiana. That single expansion is projected to create 12,000 jobs spanning Indiana, Pennsylvania, Massachusetts, and California.
The London-based drug maker GSK is also pivoting heavily, committing $30 billion over 5 years, specifically for U.S. research and supply chain infrastructure. And we are seeing aggressive moves from companies like Fujifilm, who are dropping over $1 billion to build a state-of-the-art cell therapy facility in Pennsylvania, which comes on top of a massive expansion at their existing site in North Carolina.
So if I am a listener trying to make sense of all these massive numbers, what does this actually mean for my portfolio? From a Theta Fuse perspective, this is not just an interesting political story about supply chains. It is a massive, guaranteed capital reallocation. It structurally benefits domestic infrastructure companies and aggressively penalizes heavy importers who fail to adapt.
Exactly. When a company like Pfizer commits $70 billion to domestic infrastructure, they are building an impenetrable moat. They are securing their supply chain against future geopolitical shocks, shipping bottlenecks, and trade wars. They are immunizing themselves against the exact kind of chaos that is currently destroying the airline sector.
And while we are analyzing the pharmaceutical landscape, we should briefly note the side drama occurring today that highlights just how fiercely these companies are protecting their margins. Novo Nordisk just abruptly ended its partnership with the telehealth company Hims over the distribution of copycat weight loss drugs.
That is a massive signal. It shows you that in an increasingly protectionist, high-cost environment, these pharmaceutical giants are fiercely protecting their intellectual property. They are not tolerating margin dilution from copycats, while they are simultaneously being forced to spend billions on domestic infrastructure.
The transition from a globalized just-in-time supply chain to a reshored, highly protected domestic model is the defining structural trade of the decade. The companies that successfully navigate the TrumpRx.gov platform and build these facilities will dominate their respective markets, while those who rely on cheap foreign manufacturing will be crushed by the tariffs.
Okay, let's bring it all together. We have covered the geopolitical oil shock, the airline carnage, and the hidden pharma reshoring. Let's talk mechanics. How do we actually trade the whipsaw we saw today? Let's start with the short-term strategy, fading the panic.
Fading a panic of this magnitude requires a deep understanding of the disconnect in implied volatility. When an underlying asset like oil swings 25% up in the overnight session and then crashes 15% down in just a 12-hour window, implied volatility becomes historically decoupled from fundamental reality. The options pricing models simply break under that kind of velocity.
Think of implied volatility like hurricane insurance. On Sunday night, the hurricane is sitting right offshore, heading straight for your house. The panic is absolute, and the insurance premiums, the option prices, are sky high. That was the OVX hitting 110.83. The options market was literally pricing in the end of the macroeconomic world.
When the market prices, in the end of the world, put premiums across the broader equity indices are artificially inflated to the upside by the vega component of the options price. The market makers demand massive premiums because the perceived risk is astronomical. This morning's gap down across the Dow, S&P, and Nasdaq was the ultimate Theta Fuse setup.
Let's break down the mechanics for a second. If you are staring at an S&P 500 or Nasdaq that is gapping down 1% at the open and volatility is through the roof, what is the exact play?
The mechanical trade here was to sell cash-secured puts on fundamentally strong tech and blue-chip stocks right at the 9:30 a.m. open. By selling a cash-secured put, you are essentially acting as the insurance company. You are getting paid a massive upfront premium to promise to buy a stock you already like at a significant discount if it continues to fall.
If you sold those puts at 9:30 a.m., you captured premiums that were bloated by pure, unadulterated fear. But why did we know it was a high probability trade to take the other side of that fear? Because of the first rule we discussed, the inevitable government intervention.
We knew the White House was going to step in to cool the crude market because the political cost of inaction was too high. By 1:30 p.m., the government effectively announced the hurricane was turning out to sea. What happens to the demand for insurance? It vanishes instantly.
That is the IV crush. The moment the White House floated the SPR release and the Jones Act waiver, oil tanked, the broader equity market rallied, and implied volatility collapsed. The vega premium evaporated.
If you sold those expensive puts in the morning, the IV crush destroyed their value by the afternoon. You could have bought those same puts back to close your position for pennies on the dollar by 3:00 p.m., capturing a massive profit in a single session without ever actually owning the underlying stock.
Selling into the volatility spike and riding the IV crush is the definitive short-term intraday play for geopolitical whipsaws. But sophisticated traders don't just look at the intraday noise. We also need to look at the long game, specifically utilizing ILAPS long-term equity anticipation securities. And this is where we apply the hidden pharma catalyst we uncovered earlier.
Trading the pharma reshoring via ILAPS is fascinating because you are exploiting a structural certainty. If you are looking out 12 to 24 months, you want to be positioned in the companies that are actively building these domestic moats. For anyone unfamiliar, ILAPS are just options contracts that expire more than a year in the future. They allow you to control 100 shares of a stock for a fraction of the cost of buying the shares outright, giving you massive leverage on a long-term thesis.
The setup here is to look at call ILAPS on the domestic pharmaceutical manufacturers like Eli Lilly and Pfizer. They have already secured their exemptions and committed the capital. But perhaps even more interestingly, look at the secondary infrastructure companies. Someone has to physically build these massive multi-billion-dollar plants in Pennsylvania, North Carolina, and Indiana.
The picks and shovels of the medical reshoring rush. By buying ILAPS on the engineering and infrastructure firms building these facilities, you are leveraging the guaranteed capital expenditure that the government is essentially forcing Big Pharma to spend.
It is a beautiful structural trade. You are buying time, defining your risk, and aligning your capital with a massive, unstoppable macroeconomic trend. They are shielding themselves from the 100% tariff threat and securing a massive competitive advantage over foreign competitors who haven't secured exemptions.
Before we wrap up, I want to leave you with a final macroeconomic paradox to ponder tonight. It is a thought experiment that builds on everything we've discussed today regarding government intervention versus physical supply. Suppose the G7 does coordinate successfully. Suppose they cap oil prices on paper, and the U.S. aggressively releases SPR reserves to flood the domestic market and artificially suppress the price at the pump ahead of the midterms.
I am following you so far. That matches the afternoon rhetoric perfectly.
But what if the Strait of Hormuz remains physically blocked for months? No amount of paper price caps or domestic reserve releases can replace 16 million barrels of global daily transit indefinitely. We create a terrifying disconnect. What happens to the options market when government price controls mask a physical, real-world shortage?
Wait, if they cap it at $90, but the free market is screaming that the physical value is $120, won't that just create massive domestic shortages? Suppliers will just hoard the physical barrels or refuse to sell at the capped price.
Precisely. The IV crush we saw this afternoon might just be the calm before a physical supply chain breaking point. When paper markets are artificially decoupled from physical reality by government decree, the resulting snapback is almost always violent. The options market will eventually have to price in the physical reality, and when it does, the volatility explosion will make today's 110 OVX print look tame.
We will be keeping a very close eye on the overnight futures and the OVX heading into tomorrow's session. The geopolitical premium is dormant, but it is certainly not dead.
We are reading the comments tonight. Tell us, yes or no. Will the White House actually cap oil prices, or are we going back to $120? Drop your answer below.
It's going to be a fascinating week, that's for sure.
As always, we talk options and strategies here on Theta Fuse, but this is for educational purposes only. We are not your financial advisors. Trade your own plan and stay safe in this volatility.